Welcome to Business Matters. It is our pleasure once again to share with you this lesson on accounting equation. Now, we wish to say that the accounting equation is the most important concept in understanding accounting. Now, many have made the mistake of cursory going over the accounting equation, and some have ignored the concepts to their peril later on in the accounting course. We want you not to make that mistake, and therefore we are sharing the basic concepts that are critical for understanding how to deal with accounting information. And it starts with the accounting equation. So we're now going to be looking at understanding the accounting equation. What is the accounting equation? Well, it refers to the resources owned by the business and the means by which these resources are obtained. All right? Now, the resources owned by the business are called assets. Very important point to remember. The resources owned by the business are called what? Assets. The resources supplied by the business owner is called capital or equity. And the resources supplied by others, yes, or institutions are called liabilities. Let's move on. When the business owners contribute all the resources to start the business operation, the accounting equation would be asset is equal to capital. What are we saying here? There are business entities and organizations that exist where all of the assets that came together to form to operate the business came solely from the owner. And therefore, the accounting equation, asset is equal to capital, is used to represent the fact that the owner is the only person who has contributed all the resources to the business. Let's look at an example. If John decides to start a taxi business and the cost to purchase the vehicle, the motor car, and other registration costs is $400,000, and John withdrew this amount from his personal savings account, then the asset of motor car, which is $400, is equal to capital, which is the amount taken from the bank, that is John's personal bank account. So the asset is equal to the capital. Let's move on. Now, where the owner obtains assistance to finance the business. Yes, example, obtaining a loan, a bank loan, or a loan from a friend. This resource would be owing to them and is expected to be repaid. So this is called what? A liability. So when the owner gets assistance, yes, in financing the business, that financing that the owner has received from either a person or a bank or other institution, it is referred to as liability. Why liability? It means that the owner or the business at some point in time in the future is liable to repay that amount that was given to them. Now, whenever the owner has other persons assisting, then this is the accounting equation. Asset is equal to capital plus liability. Now let's look at another scenario. If motor car values $400,000 and John got only $300,000 from his savings account and borrows $100,000 from his friend, it means that the accounting equation would be what? Asset of $400,000 is equal to capital, which is $300,000 plus the liability, the money received from friend, which is $100,000. All right, that is what it would be. All right, let's continue. Note, the accounting equation is the most important foundation in accounting. I repeat, the accounting equation, yes. And you may wonder why. The accounting equation is the most important foundation in accounting. Now, like a house being constructed, the sterility and the firmness of the building's foundation will determine how strong the structure will be. Isn't that so? Yes. If the foundation is solid, then the structure that you're going to put up have a greater propensity and ability to be strong as well. Now, therefore, students must know what? Master the concept of accounting equation in order to establish competence in accounting. So if you'd like to be a competent accountant, I want to tell you this, not just from what is said in the textbooks, but from experience, that you have to have a clear, a solid understanding of the accounting equation and the concepts that are related to the accounting equation. All aspects of accounting rest on a solid knowledge of what the accounting equation and how it works. Let's continue. So what is an asset? We talked about it earlier. What's an asset? Well, assets are all the resources or property owned by the business. Now, assets may appear in the business in two forms. Appear in what? Two forms. One, tangible assets. Now, these are items that are physical in nature, such as what now? Our building, machines, inventory or stock, or so on. And then we come to the second form, which is referred to as intangible assets. Intangible assets are items that are not physical, but adds to the net worth or the status of the business, such as goodwill, copyright, patent, and trademarks. Yes, you might wonder, then how is it that intangible asset means it not physical, you cannot touch it, but it exists? Well, let's have a look at one or two of these examples. Goodwill is really the reputation of the business, right? Or the customer base that is guaranteed in the operation of the business. So, for example, an individual that opens a KFC, Kentucky Fried Chicken business, because there is a large following and desire for KFC chicken, that if you got the franchise and open that business anywhere, yes, there is going to be an inclination for a lot of persons to come to buy from your business because it has a high level of goodwill. Secondly, copyright. Copyright is the right to an original creation or original work. Therefore, if somebody else wishes to use it, they will have to pay you to use it. Yes? Now, and it's an asset because you own that right. That right, the law gives you that right. You own it. That right to use your product or your creation in a certain way to profit from it. So it's an asset to you. All right, let's move on. So now let's look at tangible assets. Now, tangible assets are in two types, yes? One is referred to as fixed asset, or now known as non-current asset. So you may see it being referred to as fixed asset, and it is also referred to as non-current assets. Now, these are assets that are of long life and are not primarily bought for resale. So they are bought to be used in the business on a long-term basis. They are bought to do what now? Maintain the continuous operation of the business. For example, let's talk about a restaurant. You're going to open a restaurant, yes? There are some things that you are going to need to use from day to day as the restaurant continues to operate. For example, your stove, your refrigerator, your cashing machine or point of sale system. All of these are bought not for next week to sell them, but they are bought to sustain the operation of the business. So they are referred to as non-current or fixed assets. Now, fixed assets may be recorded in the statement of financial position, either according to permanence or liquidity. What do we mean by permanence? You arrange the assets based on the assets based on the duration and how long they will last in the business. And liquidity means how you arrange them in relation to the order of the ability to be turned into cash. So the non-current assets arrange in order of permanence and liquidity. Note now, for the examples that are before you, that we start with land and premises, land or premises, because land is considered, or premises is considered to be the most fixed or non-current asset. Land will last the longest. Then building, the building is structure that is put on the land. Then machines, furniture, fixtures and fitting, equipment, small tools. So the arrangement there, the asset that will stay the longest, that has longer life, is recorded first, which is the land. We look at the other table, you'll realize that liquidity now, in the form of liquidity, it's a flip. Yes, we flipped the information. So whereas in permanence, you would have land and premises come at the top. In liquidity, they'll fall at the bottom. They are less liquid. The most liquid assets, as fixed asset, would have been what now? Small tools, then equipment, then fixtures and fittings, furnitures, machine, building, etc. So the liquidity arrangement is really the opposite arrangement to the permanency listing. Let's move on now to current assets. So we talked about non-current assets. We're now going to look at current assets. What are current assets? Well, current assets are really resources or assets that can be quickly converted into cash. Yes, these are assets that within the year they are likely to be liquidated or to change over into cash. They are also referred to as liquid asset. Now here's some examples now, arranging the current assets in relation to liquidity and permanence. So when we are recording them according to permanence, then we'll have what now? Inventory coming at the top and cash in hand at the bottom. But when we come to liquidity, cash in hand means cash that you have in the business or the cash still in the business would be the most liquid. Cash equivalents, short-term what now? Investment, prepaid expenses, accounts receivable, and inventory, right? So you flip it over and you'll see that liquid assets, the cash comes at the top, but with permanent, yes, it comes at the top. Permanent inventory comes at the top. Let's move on. Now we have another type, another concept. So we have just looked at one aspect of the accounting equation which deal with what now? The asset. And we said that assets are in two categories. What are they? tangible assets and also intangible assets. And then we have broken down the tangible assets into two types: non-current assets and current assets, right? And now we're looking at liability. Now we have what is referred to as long-term liability. Now these are items, yes, where the business is given over a year to make repayment. So for example, you have borrowed some money, and the whoever you borrowed from will allow you to pay it. You have more than 1 year to pay it. Here are some examples: mortgage, debenture, bank loan. Yes, if you get a bank loan to pay in 2 years or between 2 or 5 years, it means that it is a long-term liability, right? So mortgage, take out a mortgage in relation to your house, yes? So you have 20, 30 years to pay it, right? So that's a long-term liability, right? Okay, so let's move on. Then we come to current liability. Now, current liability, these are items that will fall due within a year. So the business must what now? Make repayment as required in that year, in the period of 12 months. Yes? So when we talk about current liability, it means that your creditors, or the persons you owe, are requiring you to pay back the money within 12 months or within a year. Example: trade creditors, or what is also referred to as accounts payable, expenses accrued, bank overdraft, or any other loan under a year. All of these are referred to as current liability. Again, I want to emphasize, you should be able to look at an item and know whether this item is an asset or it is a liability. Yes, it's a long-term asset, or it is, a non-current asset or a current asset, a long-term liability as against a current liability. So let's move on. The principle in dealing with the accounting equation is that whatever adjustments are made with one side, is a similar action is necessary on the other side. What do we mean? For example, if the asset side is $5,000, value $5,000, and the liability side is 2,000 plus the equity, which is 3,000. Yes, so it means that the asset is equal to capital plus liability. It means the asset of 5,000 is equal to the capital of 3,000 plus the liability of 2,000. So if the asset side goes up by 1,000, the other side must go up by 1,000 for the equation to remain true. In other words, the equal sign saying that one side, yes, the asset side and the liability side, must remain the same, right? The sum of the capital and the current and the liability, when added together, must equal the asset. So the equal sign means both sides have the same amount for it to be true. Let's move on. So Mary Brown starts her business with $35,000 and opens her business bank account. The asset here is that cash was placed into the bank. Yes, the cash at bank is $35,000. So the $35,000 that Mary Brown used to start the business represents her capital. So the bank, the cash, or the cash at the bank, is the asset of $35,000. The capital also $35,000. Look at the next transaction. Yes, bought a machine cost $4,000 on credit from Plant Limited. How will this affect the accounting equation? Let's see. Now, we are pulling money. We are buying machine rather, but where no money movement is being done in terms of cash, we are buying it on credit, and therefore cash at bank will remain $35,000 and capital will remain $35,000. But what will happen now? We have a new asset that is valuing $4,000, and we bought it on credit, so we have a creditor, yes, a liability in the form of creditors for $4,000. So notice the debit side, asset side went up by 4,000. The liability side with the creditor went up by 4,000 as well. Let's go on. So the total asset then would be 39,000 equal to capital, which is what? 35,000 plus the liability of $4,000. Now, let's move on. Paid, look at this example. Paid $2,000 check to Plant Limited. This transaction decreases both what now? The asset as well as the liability. We are paying some money by check. So by the fact that we are paying the check, we are pulling money from our assets in the bank, the asset of the bank, right? It is reduced by what now? The $2,000. Again, we're paying for Planters Limited because we owe them. And so we are reducing the liability by $2,000. Therefore, if you see now what happens, the total assets now become $37,000, yes, because we are pulling $2,000 from the bank. It is reducing the bank amount from 37 to 35. It is reducing from 35 to 33 that would be in your bank account, right? Okay, and you're reducing the amount of money that was owed to your creditor by $2,000. All right, let's move on. So assets, the asset of $55,000. Let's look at some calculation of accounting equation. If your asset is $55,000 and your liability is $16,900, what is your capital? What we do is what is called transposition, right? To find capital, a transposition of the equation must take place. How does that look? Right? The accounting equation is asset is equal to capital plus liability. We want to find the capital, so we move the liability over to the side of the asset as the arrow is shown. And therefore, you're going to have what now? The asset minus the liability. Now, the idea in formulas, when you're moving a positive item over to the next side, it will become a negative item. All right? If you're moving a negative item over to the next side in the equation, it becomes a positive item. So that is why when we move the liability now, look at what is happening. It is asset minus liability equal to capital. Therefore, if we plug in the values, the asset of $55,000 minus the $16,900, we'll get the capital of what? $38,100. Let's move on. We have another example here. Assets amount is $98,000 and the capital is $6,200. What is the liability? All right. What we're going to do again, we're going to move what we want to find. We want to find the liability. So we're moving the capital over to the side of the asset, right? And this is how it looks. When we move the capital over to the other side, it then becomes a minus. So the positive becomes negative. So it's capital minus the asset is equal to the liability. Therefore, the 98,000 minus 62,000 will give us 36,000 for our what now? Our liability. All right. Let's look at one more example. Capital for the business is $34,000. Yes, and the liability is what? It is what? $54,000. What is the asset value of the business? Let's go to the accounting equation. Asset is equal to capital plus liability. Therefore, we know the capital and we know the liability. So when we add them, they should be equal. The sum of it should be the total asset, which is 34,000 plus the 5,400 will give us 88,000. So come on, let's lay an excellent foundation in accounting. Build your accounting on a solid foundation. If you must, go through this lesson a few times until you master it. It is very important. Everything in the future topics will be affected by your knowledge of the what? The accounting equation. Just before I close, So let me say that it is important then for you to be able to identify. You see an item and you know that's an asset. You see another item, you know it's a liability. It should be that easy. And the only way you can do that is ensuring that you master the concept relating to the accounting equation. What is an asset? What is a liability? Yes, which items are assets and which items are liabilities. One should be able to determine which items are a current asset, which items are a current liability by just seeing it. As it pops before you, you know, yes, this is a current liability. Yes, you know, it's a current asset. Once you're able to do that, you are on your way to be a successful accountant. Therefore, I thank you for sharing, and like and share this video. Click the subscribe button if you think this content is good. Thank you very much.